Hey there, welcome back to another episode of In the Money. I'm Jim Armstrong with Fidelity, joined as always by Tony Zhang, Chief Strategist at OptionsPlay. Ready for a good discussion, Tony. How are you?
I'm doing well, Jim. It's been a wild week, so looking forward to diving into that.
Lots to talk about for sure. Before we get going, just a note for our viewers. We always take a really close look at the questions that you send in when you register to attend each episode of In the Money. And we're definitely noticing a lot of people asking questions about how to get started with options trading, how to learn the basics, and how to figure out the fundamentals of placing that first options trade. As you could probably appreciate, that's not something we can cover every single week over and over again on In the Money. We're going to talk about some specific trades today. We're going to talk about the macroeconomic environment. But if you are looking to get caught up on those fundamentals and to learn the basics, we would strongly suggest you check out a resource at fidelity.com/classroom. Again, fidelity.com/classroom. If you go there, you're going to see several choices. One of the best of which we think is a 4-week options primer to get you started on the basics of options trading. It meets once a week. It's live, starts every month. It's interactive. You can talk to the coaches, you can ask your questions, and you can learn the lingo, and you can learn all the things you need to build up your confidence before you place that first options trade if you're starting net new. So again, that's fidelity.com/classroom. There's also a 4-week advanced options trader choice if you're interested in that as well. So fantastic resources that can definitely help you get more comfortable with the options world. All right, with that said, Tony, we'll turn to you. As you mentioned, no shortage of things to talk about, and would love to just start off today's episode with your sense of, what options traders, potential options traders need to think about what's happening in the macroeconomic landscape as a whole.
Yeah, Jim. The last, call it 4 to 5 weeks now, have been largely dominated by this two narratives going on underneath the surface inside the markets. If you look at the S&P over the last month or so, it's largely moved sideways. But underneath the surface, there was a very different story where you essentially had significant selling in the one industry that has been driving the markets over the last couple of years, which are AI, tech, semiconductor related stocks selling off pretty heavily while all of that money that was being pulled out of semis were being put into the rest of the market. That's why we saw as the S&P 500 was breaking below 7,400 support level, moving towards our $7,100 support level over the last couple of days, the RSP equal weight S&P 500 was breaking out to new all-time highs, showing us that there was a significant amount of rotation happening beneath the surface, where essentially defensive stocks, Dow components were all catching a bid because the broader equity markets we're continuing to show really strong corporate earnings growth as we continue on with earnings season. But the semis, the technology companies, um, last week with Meta this particular week, with Alphabet last week, showing that kind of mega cap growth is starting to hit a bit of a wall here with regards to how much they're spending in capital expenditure to build out that AI infrastructure versus the expectation of revenue down the line. And investors are starting to reach a point where they're saying no more spending without showing us, some sign of AI revenue on the back end of it. So that trade has essentially been in place for going on nearly 4, 5 weeks. And I would say yesterday was sort of the washout of that selling in that semiconductor space because this particular week was starting off with another fourth round of selling in the semiconductor space, especially in the memory names. And a lot of that was driven off of the fact that there was a significant amount of margin and leverage on those specific names. So the selling was somewhat indiscriminate, regardless of price, regardless of value, regardless of fundamentals or technicals. We were just seeing selling across the board in that specific industry. Obviously, the Chinese competition and more of the circular deals that we see in this particular space were part of what's driving that sell-off here this particular week. But I will say today, we started to see that trade that we have this narrative, this two-way narrative over the last 4 to 5 weeks start to turn on its head. That's why we've seen semis up significantly today, while the rest of the market seems to be sold off as a result of it. So the question is whether or not this is more of a knee-jerk reaction to just how oversold the semis have been, or is this actually a sign of stabilization within the semi space, and that we start to see a bit more stabilization and potential upside here going forward. Now, we obviously had the FOMC meeting here yesterday. We had the hold. Unusual amount of uncertainty going into that announcement, nearly 33% probability of a hike just a few hours before that meeting. Usually, those things are 90, 95% sure in terms of what the expectations were, but high amount of uncertainty going into it. Rates are higher here as a result of the hold. Equity markets are stronger here today, but that was largely driven by just a few stocks. It's not a broad-based buying here today, and that is a little bit concerning for me to see kind of just a bit of a bounce here in semis and tech while the rest of the market takes a back seat here.
You mentioned yesterday's Fed meeting, and we actually had a question that came in during registration from a viewer named Joanne asking, what can we expect with the new Fed chair? So looking ahead for the rest of the year, I'd love your take on whether and to what extent you're surprised that under Kevin Warsh's leadership, we haven't, he's had 2 meetings under his belt so far, including this week's. We have not seen any rate changes at all. What's your sense of why that might be, and maybe some thoughts about what the rest of the year might bring?
Yeah, that's a great question. First thing, we should probably expect less from the new Fed chair. As he states, he's not going to be giving any forward guidance. But the one thing that he did say yesterday is that he's happy to let the bond market, the higher rates in the bond markets themselves, provide that tightening financial conditions that will help fight the inflationary pressures that we currently see here in the broader markets. And that's reflected into how the 10-year yields have responded to the hold yesterday, the hawkish hold. You have 10-year yields approaching 4.7%, and that's what he means in regards to higher rates themselves will provide that tightening condition that will hopefully rein in some spending and rein in some of that inflationary expectation. But the thing I want to remind people is that, the inflationary pressures right now are mostly driven from oil. If you look at across the board, food, shelter, some of the other major contributors to inflation, those are actually, continuing to move in the right direction. That's something that we have to contend with. Now, I will say the probability of a rate hike in September has declined by nearly 20% overnight after that FOMC meeting. So maybe the bond market is sort of buying what the Fed is trying to sell here right now, which is essentially trying to rein in inflationary expectations without actually raising rates. So it's a tall order as far as whether or not he can achieve that. But that's kind of what we can, in the short run, expect from the new Fed chair at the moment. Obviously, heading into earnings season, right now, there was a lot of uncertainty around all of the AI capital expenditure. We saw Meta, we saw Alphabet last week and this week show that the markets are starting to be a little bit more concerned about that. But, Microsoft was a nice departure from the expectations, and it kind of shows that companies that are focused, especially on the enterprise side, in monetizing the existing AI models that they have are still being rewarded. Microsoft being a good example of that, up nearly 16% today. So this is really where the question is, can companies continue to justify massive AI infrastructure spend, or are investors going to demand kind of clearer paths to revenue from an AI perspective? That's really the big question for this particular earnings season. Outside of that, the corporate earnings outside of the technology space has been incredibly strong, and that's why we continue to see the rest of the market, show a fair amount of strength here, despite the weakness that we've seen here from tech. The VIX up above 20% yesterday, back below it again today, kind of providing a little bit of a contrarian buy signal on that spike yesterday. And the question going forward is this durable? And that's really what we're going to be tracking here over the next week or so.
And real quick, I definitely want to get to your first of two trade ideas in a second, but you did mention the VIX, the volatility index. What's your sense of a VIX at 20? I mean, the textbook would tell you that's right at the upper range of normal, quote unquote, volatility. What's your sense of a VIX around 20?
Yeah, and if you could call this environment that we're in normal, which is essentially after sort of the first Iran war, I would agree with you. Above 20 is sort of on the high end, and that generally speaking, we would use that as a contrarian indicator, as a potential buying opportunity. The question is whether or not we are kind of back to a more normal conditions with the things that are continuing to escalate in the Middle East. We certainly saw through March and April, or I'm sorry, in March where the VIX was consistently above 20, and that was the new normal. I don't necessarily see us returning back to that level just yet, but at the moment, the new normal is above 20 would be potentially a buying opportunity with the VIX.
All right, with that context set, Tony, let's get to your first trade idea. It's a travel stock that I think theoretically maybe could or should be having a worse time of it than it actually is. So talk us through what your thesis is here.
Yeah, so the one thing that we saw from this morning's GDP print is that the consumer incredibly remains really resilient. And one of the places that consumers are still remaining resilient in terms of spending is on travel. And Booking.com has been a stock that has been beaten down a little bit recently and actually provides, if you look at the underlying fundamentals and look at the business, best in class from a travel platform perspective, an incredibly resilient business from a profitability perspective and growth. And I think the fact that it recently broke out above that $200 resistance level on strong volume provides an interesting opportunity. Now, you have this sort of support zone that's somewhere in this 190, 200 area that now becomes a key level of support, and it gives that potential for Booking.com to recover back towards a 230 upside target that we have here. And again, this is on the back of the fact that Booking.com operates multiple, you would call best in class travel websites, Booking.com, Priceline, Kayak, OpenTable, and these are platforms that are showing significant revenue growth. We're talking about 16% year-over-year revenue growth. In terms of bookings, they're seeing 6% growth in terms of number of nights booked in terms of hotel rooms, and more importantly, they're now competing significantly with Airbnb. 38% of their bookings are now in alternatives, meaning they're not in hotels. They're really taking a decent market chunk away from Airbnb, which has been an advantage to Airbnb in the past, but now they're starting to turn that into their advantage. So between the aggressive buybacks that we continue to see here, the fact that they are significantly more profitable than their peers is what makes Booking.com an incredibly attractive long-term investment. But the charts are actually telling us that the change in trend is now starting to take place.
And so you have built out, based on that bullish thesis, a bull put spread. Would love you to walk us through it.
Yeah, I'm looking out to the September monthly expiration. I'm looking at buying the 190 I'm sorry, looking at selling the 190 puts and buying the 175 puts against that. Earlier today, you can collect about $5.85 for that credit spread, which would imply a maximum risk of $9.15 for that credit spread. And this is the type of trade where once you enter the trade, obviously three things can happen with the stock. The stock can move higher, it can move sideways, or it can move lower. When you're selling a put spread like this, two out of those three scenarios, if the stock moves higher or if the stock simply stays put where it is, this strategy will be profitable and you can collect up to that $585 per contract if the stock stays above 190. And that 190 is the breakout level that I was referring to on the chart. So that's why I've chosen selling these specific strike prices so that as long as it stays above 190, I can potentially collect the full profit potential of this put spread.
I have a viewer question for you, Tony. Actually, came in from a viewer named Ozzy during registration. He asks for a bull put spread. What are the parameters for deciding the option's expiration date? Now, he sent in that question before he knew what your first trade idea was going to be. So you can answer that expiration date question, based on this trade or sort of in general terms. But how would you answer that?
Yeah, generally speaking, whenever I'm looking at buying a or selling a bull put spread, I'm generally trying to shoot for an expiration that's roughly 45 days out from where we are today. And that September expiration is just around that mark. And I usually, if possible, I'll try to choose the monthly expirations because usually 45 days out, if you do find a weekly option, that's likely an option that was just listed perhaps just a couple of days ago. You're not going to have as much open interest and volume on those specific names. They're just as liquid, but the spreads are going to be a little bit wider, which makes it harder to gauge what the true theoretical value of those options are. So, using the monthly options, usually you can get a much better gauge for what the true price, the midpoint, if you will, is more representative of the price that you can potentially execute that trade at. So using 45 days out is usually my starting point for these types of strategies because as an option seller, you obviously want shorter dated expirations to have maximum time decay that works in your favor. But at the same time, if you use an expiration that's too close to the current price, too close to the current date, you tend to have a significantly more gamma risk, which just means that the option strategy is a lot more sensitive to even small movements in the underlying stock, which is not something you want as an option seller. So you're trying to find the balance between getting as much time decay as possible while having as little gamma exposure as possible. And going out roughly 45 days gives me that sweet spot of having enough time decay, but also relatively low gamma risk.
Got it. All right. Thank you for that. Let's hit your second trade idea of the day. You've chosen for this one a stock that I think all of us are probably familiar with. It's Adobe, but maybe your suggestion, if I'm reading you right here, is Adobe's position might be stronger today than perhaps some analysts might give it credit for. Is that fair to say?
Yeah, that's exactly right. And on top of that, the software space that has been under pressure, if you will, ever since the AI trade has been in place, is seemingly a little bit overdone. And actually, over the last 3 to 4 weeks, as the semiconductor industry has sold off, one of the biggest beneficiaries of that sell-off has actually been the software industry that took the biggest hit as a result of AI. And Adobe is certainly very much at the dead center of that. There was a lot of concern from analysts that this was the type of company that AI was going to disrupt. But ever since that concern has been in place, which arguably has been well over a year, the stock is down significantly. But Adobe continues to show record revenues and record earnings despite all of the concerns. And I think the stock price is now just starting to suggest that investors may be viewing that concern as a little bit overblown. Because if you look at the chart here, we recently just broke out above that 235 resistance level, triggering our early breakout signal. And that 235 area now becomes a key level of support towards our 350 upside target. And we have a fairly aggressive upside target because of how significantly the stock has sold off as a result of the concerns that investors and analysts have had over the last couple of years. And the market has essentially priced Adobe as sort of a legacy software company that's at risk of AI. But if you look at the earnings, the latest quarter, Adobe is one of the few companies that's really monetizing AI directly. Q2 revenue was up 13% year over year. They just tripled their AI related revenue this quarter, and which is now running a greater than $500 million from just AI related services. They've just raised full year revenue and EPS guidance. That's not a company that's seeing their business being eroded by AI. This is a company that's actually benefiting from AI. You know, Firefly and their AI workflows are becoming real revenue drivers. That was really what investors were concerned about, that those services were not going to be able to compete with some of the more cutting edge tools that were built directly into the large language models that you might be already subscribed to from ChatGPT and Anthropic. But it's very clear that kind of the enterprise customers that need IP protected AI tools are focusing on Adobe as the primary tools for that. And the valuation trading at nearly 10 times forward earnings reflects a stock that is disrupted by AI, not a stock that's being helped by AI. So I think this is an interesting opportunity for a stock that's been beaten down. Certainly, you could potentially call this a bottom fishing expedition, but that's really where I think the fundamentals and technicals line up, where that makes a lot of sense.
Excellent. Okay, and now to take advantage of the bullish thesis that you've just laid out so eloquently for us, you've put together a bull call spread. Walk us through how an options trader might take advantage of the thesis you've just explained.
Yeah, I'm going out to the same September expiration as I'm using with Booking.com, but here I'm going to be buying a bull call spread. What that means is I'm buying a 240 call option, essentially an at the money call option, and then I'm going to sell a 290 call against that. That 290 call represents a call option that's roughly one standard deviation away, is essentially the expected move between now and that September expiration. Earlier today, you can pay about $16.40 for that debit spread, and that means you're going to risk about $1,640 per contract for this debit spread, with a maximum gain potential of around $3,300. So if Adobe is below 240 at that September expiration, your total risk is $1,600. If it's above 290, which is the upper strike of my call spread, you have a maximum gain of over 3,300. So you're looking at about a 2-to-1 risk to reward ratio on a bull put spread, like a bull call spread like this.
And thank you for saying that too, because that was the one follow-up question I had based on this trade. Is that potential reward to risk ratio the reason that, for example, in this case, you would buy a call, or why you wouldn't buy a call rather than a call spread? Like if I buy into your bullish thesis, if I do my research and I agree, why would I not just buy a call rather than a call spread?
Yeah, fantastic question. If you look at just buying that 240 call, I think it's about $22 or so for that call, for just the 240 call, right? Versus if you sell that 290 call, you reduce the total outlay by around $6 or so. So you're bringing it down from around $22 to around $16 to buy this debit spread. And that reduction of about 20% of the cost of the spread will go a very long way to increase the profit potential, or rather the return on your investment, if the stock reaches that 290 level. Now, the downside of using a bull call spread is that you do cap your gains above 290, but that's why I'm very deliberate in choosing my upper strike price, of choosing a strike price that is at the expected move. So from a probability-based perspective, there is a one standard deviation chance that the stock will be below 290 at expiration, or roughly only about a 16% chance the stock will be above 290 at expiration. So I'm willing to accept the fact that maybe it overshoots a little bit to the upside, but the chances of that are relatively low. But by reducing my capital outlay and my risk by roughly 20% versus buying a call option, if it reaches that 290 level, you're going to see a significant higher return on investment using the call spread versus outright buying that call option. So I'm reducing my risk, I'm reducing the amount of cash that's required to get into this trade. And if I am right, I'm getting a higher rate of return on my investment, which is why I've chosen in this particular case to go with the call spread rather than an outright call.
Got it. Awesome. Thank you for explaining that. Tony, I want to move now to your look back trade of the week. You're going to revisit a trade in NVIDIA from a few weeks ago. What happened here?
Yeah, a few weeks ago, I laid out a bullish thesis here on NVIDIA, looking at buying that August 205, 230 call spread. And at the time, the thinking was that maybe the sell-off here in semis were somewhat contained and that we're going to see a further upside, especially on a best in class like NVIDIA. And largely, I would say NVIDIA managed to escape the sell-off in semis largely unscathed, But despite the fact that whenever you buy a call spread, if the stock moves sideways or even moves a little bit lower, those trades will erode in value. And that's exactly what happened. We bought this call spread for $7.70. It's now trading around half of that, $3.95. And whenever you buy a call or a call spread, once it loses about 50% of the value that you paid for, chances of the stock getting back to your break-even level and beyond by that expiration date is fairly low. So in this particular case, my choice to do what I'm choosing to do here is simply cut my losses and move on. Maybe I might reestablish a new position in another semiconductor stock now that we're seeing some stabilization in the semis, but likely I'll probably choose something with a higher beta and try to capture that bounce or capture that upside rather than holding on to this particular stock and hoping that it will bounce back. So I'm choosing to cut my losses and simply move on and keep the $3.95 that I can retain from this particular trade and apply to the next trade.
I actually have a couple of questions, Tony, about this look back trade. The first one comes from a viewer named Eugene. When he registered, he asks, with AI stocks seeming to cool, what industry could potentially be the best one to look at next from the perspective of an options trader? How would you answer that?
That's a $1 million question, right?
Right.
One of what we do is we track, we track, call it industry and sector rotation very closely. We look at where is money rotating out of and where is it rotating into. Over the last 5 weeks or so, as stocks were rotating out of the AI stocks, it's been very clear that that money was flowing largely into financials, into healthcare, into defensive industries for the most part. Now, we have seen that reverse today. We saw, really tech and semiconductors roar back to life while everything else sold off. But however, one day doesn't make a trend. I don't necessarily know that what we're seeing here today is necessarily durable in terms of AI because the concerns that drove the sell-off in AI have not gone away. The competition out of China has not gone away. If anything, it's intensified in the last couple of weeks. The concerns around the circular deals have certainly not gone away. So, what I look at is really sector rotation to help me answer that question. And I don't necessarily know there is one answer to it. The answer to that question is constantly shifting. So looking at sector rotation and industry rotation is a good way to get a sense for as money flows out of AI, where is it flowing into? And like I said, over the last few weeks, that's been more defensive in healthcare, financials, industrials, those types of stocks were the beneficiary, even consumer discretionary and consumer staples to some degree were the beneficiary of that money flowing out of AI, which is why we were looking at stocks like Booking.com as an opportunity today.
Moving target for sure there. I have a more of a psychology question, I think, Tony, for your look back trade today. You've decided to, with this particular trade, cut your losses, as you said. And I can't tell you how many times I've been in the position where I've looked at a position and it's not going the way I thought it was going to go. It's headed in the direction that I didn't want it to go in. And I have sort of this war inside my head about, oh, maybe it's going to turn around. Sort of sunk costs have already dictated that I'm here. Maybe I should just wait. Uh, it's a really difficult decision, I think, for a lot of options traders to make that call and cut your losses and maybe try to save a couple of dollars, maybe try to save a couple of brain cells and free up some mental energy and not worry about it anymore. But can you talk a little bit more about how you actually make that call? I just think it's an exceptionally difficult one to do for a lot of us.
Yeah, it's a fantastic question. And you mentioned one thing in as you framed the question that I think is probably more important than anything else. And it's one of the things that we almost never talk about because we always talk about financial capital. We talk about how much money we make or lose on a specific trade, and we try to make all decisions around that. But the one thing we don't talk about is mental capital. And mental capital arguably is more important for you as a trader to remain disciplined and stick to your specific rules. And the more time you spend stewing over your trades, trying to decide, should I stay in, should I stay out? Do I look at this? What if this? What if that? The more you erode that mental capital and you end up being frustrated, you end up being consumed by it that you end up making suboptimal decisions, which is why when it comes to facing losses, there's a difference between if a trade is profitable versus if it's not profitable. Because trades that are not profitable, you should have a very black and white rule as to when you cut losses. Meaning, this is the part of your day that should consume the least amount of your mental energy. Either a position has reached its stop loss threshold or it hasn't. And it's a black and white rule. The more you can force yourself into that position, the more mental capital you'll preserve and the more mental capital you'll have for making the hard decisions. The hard decisions are actually when the trade is profitable. What do you do when a trade is profitable? Because the thing that we as human beings want to do with all our profitable trades is take our profits and run. But in reality, if you look at the most successful traders, the traders that show the highest amount of performance, it's the profitable trades are the ones where they add more. They buy more. They're adding more exposure because that's really where the market has proven their views to be correct, and that's really where you want to be investing more of your capital are in the trades where your thesis has turned out to be correct, and that is mentally very hard to do. Because everything in our brain tells us when we have a profit is to take our profits and run. So it's a long-winded answer to your question, but it's incredibly important that on the downside, we try to keep the rules as simple as possible, as black and white as possible, so that we reserve that mental space for, where it's a lot more challenging, which is what do you do with a winning position? How do you add more? When do you add more? How much more do you add more? That's the hard question. And that's really where you want to make sure that you have as much mental capacity for those decisions.
Lots for me to work on. So Tony, thank you for your candor there. I really appreciate all of your trade ideas and that last answer. Thank you again for that.
Thank you so much, Jim. It's been a pleasure.
Thanks also to everyone watching us as well. Don't forget to please tune in tomorrow to the Trading Strategy Desk follow-up session. That's again tomorrow, Friday at 1:30 p.m. Eastern Time. You can sign up for that visiting the URL that you see on your screen right now, fidelity.com/in-the-money-follow-up. And if you're looking for further insights, we would also suggest you're more than welcome to also sign up for the Active Investor Weekly Newsletter. It's going to offer a highlight of the trades discussed, and you can do that by visiting fidelity.com/activeinvestorweekly. And a final plug I'll squeeze in there for fidelity.com/classroom. If you're looking to learn more about options basics or advanced trading, great options for you there as well. Tony and I will be back here for next week's episode of In the Money. Until then, take care.